Welcome to the Stock Market Palantir. Today we are going to talk about BTQ.
Right, and specifically BTQ Technologies. It's a really complex case, and a company that's undeniably at a critical inflection point right now.
It absolutely is. I mean, you look at the numbers, it's trading somewhere around, 830 to 875 million as of this month, November 2025. And the reason we're talking about it is this incredibly aggressive strategic pivot they've made.
Aggressive is one word for it. They're going all in on vertically integrated quantum hardware.
Exactly. Through the acquisition of QPerfect and its neutral atom technology. And that, I think, brings us to the core of our discussion today. The real question is the market getting this right?
Well, that's the debate, isn't it? On one hand, you have this massive strategic shift, but on the other, the market is applying just a deep discount compared to their peers. We're talking about companies like IonQ, which are valued orders of magnitude higher.
Precisely. So the disagreement really centers on whether this foundational value they're creating, this aggressive vertical integration, means we should see an immediate re-rating, a rapid closing of that immense valuation gap. My position is that the fundamental transformation has created enormous, currently unrecognized potential that's just being obscured by market dynamics.
And I come at it from a different angle. I believe that valuation gap is there for a reason. It's entirely reflective of the very real risks and structural challenges here. We're talking about a complex capital history, a concerning market microstructure, and just the sheer technical hurdles of what they're trying to do.
Okay, well, my thesis is built on what BTQ is becoming. They've effectively leaped up the value chain. They're transforming from what was, a pretty niche post-quantum cryptography or PQC software provider into a genuine full-stack hardware manufacturer. That QPerfect acquisition, that's what secures their roadmap with neutral atom technology, an architecture that most people in the space agree offers superior scaling potential.
The potential is there. I won't argue that.
Well, that superior scaling potential is key to this whole argument. I mean, just look at the data. IonQ, which uses trapped ion technology, is valued at close to $20 billion. That's a premium of nearly 23 times BTQ's current market cap. So if BTQ successfully executes on its neutral atom architecture, and this is an approach that promises much higher qubit connectivity, easier manufacturing scale, things that are real headaches for trapped ions, a re-rating to even $2 or $3 billion becomes mathematically almost inevitable, even if they only get a fraction of IonQ's premium. This isn't just growth, it's a monumental arbitrage opportunity.
I see why you'd call it an arbitrage, but I would argue that gap exists for extremely rational, risk-based reasons. My concern is that the current valuation is heavily discounted not just for the tech risk, but for structural and legacy issues. I see three primary reasons for this discount: the capital history, the market microstructure, and the execution risk.
Okay.
So let's start with the capital history. That 2023 reverse takeover, the RTO, is still a huge source of confusion. A lot of retail investors, and frankly, some basic technical analysts, mistake that RTO, which is a really complex legal and financial maneuver, for a simple reverse stock split. The result? The historical charts before February 2023 look fundamentally flawed. It just muddies the waters for anyone trying to do technical analysis.
But that's confusion about past bookkeeping. That's not about future technological viability.
It is absolutely a structural risk because it impacts genuine price discovery. But, okay, let's move to the deeper issue, the market microstructure. You mentioned the percentage earlier. Over 62% of this company's trading volume happens off-exchange. It completely bypasses the public order book.
And for listeners who might not track microstructure, that is a crucial point.
It's critical. When trades happen in dark pools or through wholesalers, big institutions can move in and out without showing their hand to the public. It raises serious questions about whether the market is genuinely reflecting buying pressure, and it strongly suggests potential price suppression. And that alone justifies a discount, regardless of how good the QPerfect tech might be.
You brought up that 62% off-exchange figure, and I agree it's statistically significant. It demands attention. But I disagree fundamentally on how you're interpreting it. You see high dark pool volume as suppression. I see it as institutional accumulation.
Okay, tell me why I should believe it's accumulation. If these institutions were so confident in an imminent re-rating, why aren't we seeing the stock break out? That high dark pool volume, combined with an extremely low short interest, the days to cover is only about 1.03, it suggests that large players are not betting on some big aggressive breakout. It looks like they're just quietly managing the price to absorb shares.
But that absorption is the accumulation strategy. I mean, think about it. For an institution trying to build a position in a small cap like BTQ with a tight float of around, 94 million shares, they have to use dark pools. If they put those huge buy orders on the public exchange, they'd immediately drive the price up against themselves. It's the only way to do it without slippage. And this behavior is happening right before a powerful catalyst, the MSCI Canada Small Cap Index inclusion, which takes effect at the end of this month. This dynamic basically confirms that smart money has done their homework, they've validated the thesis, and now they're absorbing supply ahead of what will be mandatory buying from index funds.
That is a compelling point about the MSCI inclusion. It does generate forced buying, no question. But let's be clear about what that is. Index funds are passive buyers. They don't signal any conviction in the fundamentals. They're just following rules. It's a short-term liquidity event. It doesn't solve the long-term cash crunch, or more importantly, the hardware execution risk.
Okay, so let's pivot back to that fundamental risk then. The credibility of this whole vertical integration strategy. I argue the strategy is actually de-risked because it's a three-pronged approach. You have hardware with neutral atoms, you have the software with the BTQ simulation, and you have the vital security business, the PQC legacy business.
Right.
And that security arm is the unsung hero here. PQC is aligned directly with huge regulatory tailwinds, the upcoming NIST standards, and B2Q already has commercial validation with pilots like their quantum secure stablecoin network. This PQC revenue provides vital, immediate cash flow, while the really capital-intensive hardware side matures.
That's a nice story about diversification, but let's look at the financial reality. The PQC revenue versus the cost of scaling this hardware. I mean, developing a commercially viable neutral atom quantum computer is astronomically expensive. And the technology, while it has this fantastic scaling potential, it faces just immense, unprecedented hurdles in error correction and achieving high fidelity across all those qubits.
Sure, it's a challenge.
It's a massive challenge. If Q-perfect centerpiece, the quantum logical unit, or QLU, fails to deliver the fault tolerance needed for real commercial use, then that entire hardware premium it evaporates. The valuation reverts to a pure software multiple, which is far, far lower. And we haven't even touched on the complexity of a cross-border M&A. Acquiring a deep tech French company introduces all sorts of execution risks and even potential geopolitical scrutiny. That initial price dip after the Q-perfect acquisition was announced, that was trader fear. Fear of execution risk and cash burn.
I acknowledge the technical risk is real. But that's where the software element comes in to mitigate it. It creates the commercial runway. The BTQ simulation platform's compatibility with NVIDIA's CUDA-Q platform, that was a stroke of genius.
How so?
By plugging into NVIDIA's massive ecosystem, BTQ creates an immediate and scalable user funnel. This generates predictable licensing revenue while they are still solving the hardware problems. It gives them a strategic commercial path that a lot of pure-play hardware companies who are just burning cash, they simply don't have.
Okay, let's talk about that cash burn and the runway, because that brings us right back to the valuation gap. The market is correctly applying what we'd call a discount for uncertainty, and for very practical reasons. BTQ is a later entrant into this hardware race. Their neutral atom hardware is right now less proven and, crucially, less accessible than IonQs, which you can already use on major cloud platforms.
For now,
The market isn't going to price BTQ as a $2 or $3 billion player until they provide tangible proof of fault tolerance. And we have to look at their balance sheet. See $39.4 million as of Q3. That is remarkably lean for a hardware manufacturer entering a major R&D phase. This signals inevitable future dilution, likely through their retained universal shelf registration.
Can you just quickly explain the significance of that shelf registration for our listeners?
Sure. A universal shelf registration is basically a pre-approved filing that lets the company sell new shares or debt very quickly. While it gives management flexibility, the market sees it as a constant headwind. It means they can dilute existing shareholders almost instantly to fund operations. And given the burn rate for quantum hardware, dilution seems inevitable. It acts as a constant pressure against the stock price.
I'm just not convinced by that line of reasoning because it focuses purely on financing mechanics, not on the strategic advantage they're building. You're ignoring historical patterns. Companies that control both hardware and software, this walled garden full stack ecosystem BTQ is proposing, they historically command a premium multiple. They're not just selling a chip, they're building an optimized full solution. And we shouldn't dismiss their recent financing either. The July capital raise was led by a new fundamental long-term institutional investor. That signals that some high-caliber due diligence has already validated this roadmap. Smart money is already making a calculated bet. So that valuation gap, it isn't a reflection of uncertainty. It's the clearest sign of an under-recognized opportunity.
It is certainly a massive opportunity, but the discount reflects the difference between potential and proof. IonQ has proof of cloud accessibility. They have hardware that runs real customer workloads today. BTQ has a proof of concept for a superior architecture, but they also have a lean cash position, an opaque trading mechanism, and significant technical hurdles still ahead. Until that QLU demonstrates verifiable commercial fault tolerance, that discount is just justified risk management. Investors are waiting to see them move from R&D theory to commercial reality.
Okay, so to summarize my position, BTQ has executed a fundamental and crucial pivot. It completely re-rates the company's outlook. They are now a diversified entity spanning the holy trinity of quantum tech, hardware, software, and security. The market microstructure, while it looks complex, I believe it suggests institutional accumulation is happening right now, positioning BTQ to eventually close that massive valuation gap, driven by the superior scaling of neutral atom architecture.
And to summarize my view, while the long-term potential for that architecture is undeniable, the immediate path forward is highly capital-intensive and subject to significant dilution risk and just formidable technical execution hurdles. I think investors have to fully digest the legacy RTO complexity, the concerning market microstructure, and the severe risks of commercializing a novel quantum architecture with a tight cash balance, before they can conclude that the current market discount is unjustified.
Ultimately, it seems sophisticated market observers have to carefully weigh both the transformative, the asymmetric upside potential against the complex structural and technical risks that come from this massive strategic shift.
A lot to consider.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.